Chapter 11 is fairly brief. You should read the chapter and complete the preview questions for Chapter 11 before you play the narrated PowerPoint lecture. The preview questions for Chapter 11 are on a page with those for Chapter 10, so it's only half a page. In Chapter 11, we look at break-even analysis, we look at operating and financial leverage as well as combined leverage, and we discuss when debt financing can be beneficial for the firm. So Chapter 11, our coverage is fairly brief. Read the chapter, do the preview questions, and play the lecture. The initial issue in Chapter 11 we wish to explore is the fact that forecasting risk exists when we are trying to analyze the net present value, internal rate of return, etc. for capital budgeting projects. That's because a capital budgeting project is a very long-lived project, and we have to forecast cash flows into the distant future, and there's certainly going to be some error in trying to forecast those cash flows, so the NPV and the internal rate of return may differ from what we expect. The textbook uses the term what if analyses for three categories that we use to measure forecasting risk. The first what if analysis is called scenario analysis. As it sounds, scenario analysis is where we come up with different scenarios. Those tend to be a best case, worst case, and a middle or expected, or what we call the base case forecast. Those scenarios then have everything for the best case scenario coming out like roses. The sales volume would be higher, than we expect, perhaps the highest level we believe is possible. The cost would come in at the low end of the spectrum, which would be a good thing. And so we forecast everything in the best situation for the best case scenario. The worst case, just like it sounds, we would forecast the revenues to be low and the costs to be high. And in the base case scenario, we forecast everything to be as we expect. So if we get a positive NPV under the best case scenario, that's certainly encouraging. If we also get a positive NPV in the worst case scenario, then we have a lot of confidence that a project really truly will end up adding value to the firm. It will end up being a positive NPV project, even if our forecasts are overstated quite a bit and the worst case does happen. The revenues come in low, the costs come in high. If the NPV is still positive in that case, then we're probably really in really good shape. The base or expected case is what we tend to use. We tend to use the expected revenue and the expected costs, etc., to calculate the NPV. And these scenarios that we look at here indicate how well things really could turn out or how badly they could turn out as well. It gives us some idea how much forecasting risk we're dealing with. The second what if analysis is called sensitivity analysis. And this is where we change one variable at a time to see how sensitive the project's NPV is to the change in that one variable. So the sensitivity could be to see how the NPV changes if we lower the revenue by 10% or 20%. How sensitive would the NPV be to a change in the revenue? So we would reduce the revenue by 10% from what we expect, recalculate the NPV, see what it is. Lower the revenue by perhaps 20% and see what happens to that NPV. If the NPV is very sensitive to the revenue number, then we know we have got to have really, really accurate revenue forecasts in order to have any confidence in our NPV that we've calculated. And then simulation analysis is where we establish a probability distribution for different variables, such as we know what we expect the revenue to be, but do we have some idea about the dispersion or the risk or uncertainty of that revenue? In other words, do we have a standard deviation for revenue, and then we could develop a probability distribution for the revenue and then draw revenue numbers from that distribution. We could do the same for the costs develop a probability distribution for the costs, and then through computer simulations see what kind of distribution we get for the net present value of a project. Exactly how to carry that out is a little bit beyond our scope, but it does give you some idea what an analyst might look at, or a financial manager, to have some idea how much confidence they have in their NPV estimates. The main topic in Chapter 11 is to look at break-even analysis and some basic cost, volume, profit analyses. We make the traditional cost assumptions from economics, dealing with fixed and variable costs. The fixed costs or indirect costs are by definition fixed, so they do not vary in total as the output or the volume increases. They stay the same in total. Well, obviously, if the total fixed costs are the same, then the more units you produce, you spread the fixed costs over a greater number of units, then the fixed cost per unit will decline as the level of production increases. And we treat depreciation expense just like any other fixed cost. It is fixed in total and decreases per unit as output increases. Variable or direct costs are constant on a per unit basis, but they do increase with the level of production. If you incur the same variable cost per unit, then if you produce more units, you'll incur more total variable costs. Now, contribution margin tells us how much each unit contributes toward covering the fixed costs and hopefully contributes toward earning a profit. The contribution margin is the sales revenue minus the variable cost. That tells you how much is left after covering the variable costs, which would contribute toward covering fixed costs and earning a profit. So the total contribution margin is sales revenue minus variable cost. It's also the number of units you sell times how much you sell them for per unit minus the variable cost per unit. Now, if we always sell goods at a constant price, no matter how many units we sell, if we sell them all at the same price, and then we assumed above that the variable cost per unit is always the same, then the difference, the contribution margin per unit, is constant as well. Constant selling price minus constant variable cost per unit gives us constant contribution margin per unit, regardless of the number of units of output. Now, the accounting break-even is the number of units we have to sell, either in a dollar sales volume or number of units, whichever way we want to present that, that will produce zero net income. Another way to think about that is we have to generate enough contribution margin to cover all the fixed costs, including the depreciation expense. The break-even quantity says take those fixed costs and divide by how much each unit contributes toward covering those fixed costs. In other words, this denominator, the selling price per unit minus the variable cost per unit, is the contribution margin per unit. Remember, that's how much each unit contributes toward covering the fixed costs and hopefully earning a profit. So if we take the fixed cost and we divide by how much each unit contributes toward the fixed cost, then that gives us the quantity of units needed to break even to just cover all those fixed costs. The output needed to break even in a dollar volume then would be this number of units we sell multiplied by the selling price per unit. So we can talk about breaking even, how many units we have to sell, or what our sales volume would have to be in order to break even. In example 11.1, we're given some background data for XYZ Corporation. And this company sells widgets for $100 a piece, and their variable production costs are $40 per widget. And you're probably way ahead of me there. You can already see the contribution margin per unit per widget is $60. They sell for $100 a piece. The variable costs are $40 a piece. Each widget contributes $60 toward covering the fixed costs and hopefully earning a profit. Total fixed costs are $600,000. So the question is, how many widgets have to be sold to break even? How many widgets have to be sold to cover the $600,000 fixed cost? Well, with each unit contributing $60 toward covering the fixed cost, it would take 10,000 units or 10,000 widgets to cover the $600,000 in fixed costs. In a dollar sales approach, it takes 10,000 widgets to break even. With each widget selling for $100 a piece, the dollar sales volume to break even then would be $1 million in sales, or 10,000 units on a number of units basis. Now, operating leverage takes these traditional cost assumptions and looks at how operating income, or with certain assumptions, such as if we ignored depreciation expense, for example, and had everything on a cash basis, how the operating cash flow would change as sales change. Leverage, we've typically used leverage to mean the use of debt or some sort of multiplier. In this case, this is a multiplier use of the word leverage. When there's operating leverage, we have incurred fixed costs, and the trade-off there is that we incurred fixed costs so that we can operate more efficiently by reducing our variable cost of production. So we've made a trade-off. We've taken on risk because we've incurred fixed costs that have to be covered, have to be paid. And the reason we took on the fixed cost is so we could have a lower variable cost per unit of production. An example of this would be to make a large fixed investment, such as in an automated or robotics-based assembly line, so that we can reduce our labor costs and operate more efficiently. So we've traded the fixed costs we've taken on to maintain the robotics line and install it, etc., so that we can reduce our variable cost per unit of production. The benefit is, if your production volume is high enough, then you've lowered that variable cost on a large number of units, and it would more than pay the fixed cost you've taken on. So that's the idea when you make a fixed cost investment, is that you'll have enough volume to recover the fixed cost and perhaps even have more operating income and operating cash flow. So operating leverage looks at how the operating income changes as sales change, and when you have fixed cost, you'll find that your operating income will change even more rapidly than the sales as you incur the lower variable cost of production and spread those fixed costs over a larger output level. Then you'll find your EBIT goes up even faster than your sales when you have fixed costs. To discuss operating leverage, we have to start at a current base sales level. So the calculation of DOL, degree of operating leverage, has a subscript S on there to tell us at what base sales level that was calculated. Degree of operating leverage is calculated by taking the percentage change in EBIT or operating income from the base sales level to the new sales level and dividing by the percentage change in sales from the base sales level to the new sales level. If there are no fixed costs, there's no operating leverage, and so your EBIT or operating income will change at exactly the same rate as sales. Everything is variable, so if your sales go up 10%, your operating income will go up 10% if there are no fixed costs. Example 11.1 Part C takes the same information from the widget company and says that, well, currently they're operating at this initial or base sales level of 20,000 units. We forecast that their sales level will increase by 20%. We need to look at how the operating income changes from the current sales level of 20,000 to the now higher, 20% higher sales level of 24,000 units. So let's start with the EBIT at the base sales level of 20,000 units. Remember, the widgets sold for $100 a piece, and the variable production costs were $40 a piece, so the contribution margin was $60 per unit. We're currently selling 20,000 units. That's $1.2 million in total contribution margin. When we take off the $600,000 fixed cost, that left operating income of $600,000. Now we have to recalculate the EBIT after the sales increased by 20% from 20,000 up to 24,000 units. All the other costs are the same: selling price, variable cost per unit, total fixed costs. So if the unit sales go up to 24,000, the operating income will go up to 840,000. The EBIT has gone from 600,000 up to 840,000. EBIT has increased by $240,000, which is a 40% increase based on the 600,000 EBIT where they started. So EBIT goes up by 40% even though the sales only went up by 20%. So it's the incurrence of the fixed cost, which gets spread over a higher output level, that causes the EBIT to rise faster. In this case, twice as fast as the sales rose. So the degree of operating leverage is 2 times. The EBIT changed by 40% when sales changed by 20%, so the DOL is a factor of 2. Your EBIT changes twice as fast as your sales change because you have the fixed cost of production. Now in Part D, it asks us to calculate the degree of operating leverage again, but it gives us a shortcut to do that. Originally, in Part C, we calculated the EBIT under the base level, and then the higher forecast sales level had to calculate the percentage change of EBIT divided by the percentage change in sales. This shortcut formula will do all that for you. Simply put, it's the total contribution margin in the numerator, quantity times the price minus variable cost per unit there, divided by that total contribution margin with the fixed cost subtracted. So the 20,000 units at the base sales level times the selling price of 100 minus the variable cost per unit of 100 is 1.2 million in the numerator. The denominator is that same 1.2 million with the 600,000 fixed cost subtracted, so the denominator is 600,000. So you have 1.2 million in the numerator, 600,000 in the denominator. You get the degree of operating leverage of 2, or as we say, 2 times, just like we did in Part C of this example 11.1. So the EBIT goes up twice as fast as sales. We can calculate it directly by using this shortcut formula. You don't even have to know by how much the sales are going to change, because it's going to be the same DOL whether sales go up by 10% or 20% or 30%. In Part C, we just used a 20% change, so I could give you a base sales level and then a higher sales level. With the shortcut formula, you can see that you're calculating this DOL at the current sales volume, and it doesn't matter by how much sales change. All you know is the EBIT will change twice as fast as the sales change. Now, financial leverage introduces debt and the related interest expense as just another type of fixed cost, if you will. The degree of financial leverage is calculated at some base level of operating income. And then it looks at how earnings per share changes as the operating income changes. And there's a nice, neat shortcut formula for this. Instead of having to calculate EPS under a base and a new sales level and do the same for EBIT, we'll just express this as the shortcut formula. Take your base level of EBIT and then divide that by the EBIT minus the interest expense, and that will tell you the degree of financial leverage the firm has. The more debt, the greater the interest expense, everything else equal. So the more debt, the greater the degree of financial leverage the firm has, so the EPS will change even faster than EBIT changes. So part E, continuing with the same example 11.1, we say that XYZ has $1 million in debt at a 10% interest rate. Go back to its base level of sales of the 20,000 units, the EBIT was $600,000 at that base sales level. The degree of financial leverage is calculated by taking that base level of EBIT and dividing by that same EBIT minus the interest expense that the firm has. On the $1 million in debt at a 10% interest rate, then the firm has $100,000 of interest expense. So the financial leverage is the $600,000 EBIT divided by that EBIT with that interest expense subtracted off. So this tells us that the firm's earnings per share changes 1.2 times as fast as its operating income changes. That's because of the use of debt. That the firm has incurred some interest expense so it can employ even more assets, and that benefits the stockholders. When sales go up, the EBIT will go up. Well, then the earnings per share goes up even faster. So the incurrence of debt has levered the position, and it benefits the shareholders when sales go up because their earnings per share goes up even faster than the operating income. Combined leverage takes the degree of operating leverage and the degree of financial leverage and puts them together. It so turns out it's just the product of the two. The operating leverage was the percentage change in EBIT divided by the percentage change in sales. Financial leverage was the percentage change in earnings per share divided by the percentage change in EBIT. So the product of those two would cause the percentage change in EBIT to cancel out, and that would leave us the percentage change in earnings per share divided by the percentage change in sales. So combined leverage combines the other two leverages to look at how the firm's earnings per share changes as the sales change. Now for XYZ, the degree of operating leverage was 2, and the degree of financial leverage was 1.2, so we should expect the degree of combined leverage to be 2.4. Now, there is a shortcut formula that will allow us to calculate the degree of combined leverage directly. And it should look fairly familiar. We've got that total contribution margin in the numerator, and we've got that total contribution margin in the denominator. And just like the shortcut to calculate degree of operating leverage, we subtract off the fixed costs. And just like the shortcut to calculate the degree of financial leverage, we subtract off the interest expense. So the degree of combined leverage is the total contribution margin at the base sales level divided by total contribution margin minus fixed costs minus interest expense. So continuing example 11.1 for XYZ producing their widgets. The product of the operating leverage and financial leverage of 2.4 times should be confirmed by that shortcut formula. It says take the total contribution margin in the numerator, 20,000 units at the base sales level, times the $100 selling price minus the $40 variable cost of production. So the total contribution margin in the numerator there is 1.2 million. Divide by that same total contribution margin of 1.2 million minus the 600,000 fixed costs minus the $100,000 interest expense. So that denominator is the 1.2 million minus 600,000 minus the 100,000 interest expense, or 500,000. So we have a numerator of 1.2 million and a denominator of 500,000. The degree of combined leverage is 2.4. So the firm's earnings per share will change 2.4 times as fast as the firm's sales. As you can imagine, then, if the firm has debt as well as fixed production costs, then this is a good thing when sales go up and the firm is doing really well, because those fixed production costs are fixed and the interest expense is fixed, but those provide them benefits because they are able to employ more assets by using debt, and they paid the fixed production cost to lower their variable costs per unit of production. So this allows their earnings per share to go up faster than the sales go up. So when the firm is doing really well with a lot of sales and they have these fixed costs, then the firm's EPS is going to go up even faster. The bad news is we're incurring fixed costs, and those fixed costs have to be paid. Both the fixed cost of production and the interest expense have to be paid regardless of the firm's output level. So in really bad years, then the firm may not be able to cover those costs, and thus the firm may face bankruptcy, or certainly the stock price could be forced down because they are not able to cover those fixed costs in years when sales are weak. The stockholders get paid last, so the debt holders, the fixed cost of production, and the interest on the debt have to be paid first before the stockholders get anything. And if those costs can't be covered, you can imagine dividends are probably not going to be paid, and the stock price will probably suffer. So leverage amplifies things in both directions. It's beneficial when sales are up or at healthy levels because the earnings per share and the return on equity is going to be good, and when the sales take a downturn, then those performance measures are not going to be so good. In Chapter 11, we learned how to calculate the break-even output level for a firm, and we learned how to calculate operating, financial, and combined leverage to determine when debt can be beneficial for the firm. Now that you've completed the Chapter 11 lecture, you should complete the supplemental homework practice problems at the end of the chapter in the course notes. The solutions may be found on iTunes U, where I use the document camera to work those, or you may look at the PowerPoint file posted to Blackboard where the answers are given. So work those first and then check your answers one of two ways. Attempt the blank Connect assignment posted to Blackboard and then do the online Connect assignment. You should check the syllabus for the chapters covered and the due date for each Connect assignment, because some Connect assignments cover more than one chapter. Come to class and we'll go over the solutions to that blank Connect assignment. If you want us to look at your actual Connect assignment that you took, you need to print it out or bring your laptop so that we may see the actual assignment that you completed, and we'll answer any other questions you have over the Chapter 11 material during class. Begin preparing for the exam early by compiling your formula sheet chapter by chapter as you go. And remember, we repost every Connect assignment for additional practice after the due date, so you may work it an unlimited number of times because it will generate a new problem every time you work it.